Okay, I'd like to take this opportunity to welcome everybody to today's sneak preview top 10 stock picks. You got John Hopkins here, Tom Bowley going to join in just a minute. Anybody new to Earnings Beats, want to welcome you to our event. And of course, our seasoned veterans, thanks so much for your support over the years. This event, like all of our events, will be recorded. You'll have an opportunity to listen anytime you want. If you got to leave early, not to worry, we'll make sure that everybody gets a copy of this recording. Today is a sneak preview of our May 19th event when we unveil another batch of stocks. So today, Tom's going to give you a little preview of what that might look like. And what has been, Tom, the only way to describe it right now, especially for tech stocks, a challenging market.
Yeah, I'll tell you, looking at the report today on Trade Desk, I mean, if that doesn't summarize what the market is doing right now, I don't know what does. I mean, they came out, they crushed their earnings expectations by about 75%. I think they came in like $1.42 versus 81 cents, something like that. And they,
Hey, Tom, I'm not sure if it's my computer or if you're talking.
Can you hear me? Abby, Aaron?
I can hear you. You're good.
Oh, okay. So it's just John that can't hear me. John, well, he's not going to hear, but hey, Abby, can you see if John can hear you? Just let him know I've got this.
Sure thing.
Okay,
Okay.
I think I'm in better shape now, Tom.
What's that? Can you hear me? All right. I'm not really sure whether he can hear me or not, but anyhow, yeah, looking at the market, I was just talking about Trade Desk. I mean, that report really, I think, is almost a poster child for what we're looking at, what we've been looking at. I've got an earnings reaction spreadsheet that I'm working on getting an update to all of our members. Should be ready for download here in the next day or two. But it's all the way through Friday's earnings. And the one thing that stands out loud and clear in this earnings season is that technology stocks, even if the numbers come out good, technology stocks are being sold. And on Trade Desk today, the stock crushed its bottom line number. They beat by about 1% on revenues, and then they raised their revenue guidance going forward. Now, they did say there was some uncertainty in terms of their earnings going forward. So that's the last thing that investors want to hear right now with regard to technology stocks. But the overall numbers were strong. And after gapping down, I don't know, maybe about $15 or 20. I'm not sure exactly how far it was down, but it went down a lot more than that. It was down about 26% on the day. Maybe it was 15% at the open, but it was down about 26% the last time I looked. Just absolutely getting crushed. And when you look at a lot of the stocks that were selling off today, a lot of the losers, many of them were growth stocks, many of them technology stocks. So we've got our hands full in terms of the technology area and many of the growth names. I don't know. Well, first of all, I think they're going to be back. I think they'll be back with a vengeance, but is it going to be in the next week, the next quarter? I don't know. I would suspect that we're going to see a pretty strong fourth quarter out of technology, but between now and then, just about anything goes. And on a relative basis, the group's broken down. Now, you can look at a long-term absolute chart, and you could still make a case for technology still being in an uptrend. But on a relative basis, you cannot make that argument. On a relative basis, we've gone now to about a 9-month relative low to the S&P 500. We'll go through all of that in just a little while. But I do want to welcome everybody. Really appreciate you stopping by. I think we've got some pretty good information for you here, especially if you're new to Earnings Beats, to give you an idea of some of the things that we do. As far as these portfolios that we put together, they're comprised of 10 equal weighted stocks. The long-term track record, excellent. The recent track record, the last quarter, not so good. 3 of our 4 portfolios have been hit pretty hard, and mostly because of the move out of growth stocks and more toward value. Timing is pretty important in the stock market, and I think that our timing of the last portfolios on February 19th was a very challenging day, and I'll explain that as well in just a couple minutes. Before I get into any of that, though, I just want to walk everyone into the earnings beat site. So I'll go ahead and grab the screen here for everyone. And at earnings beats, if you go and click on this webinar special, you'll see that we've got a special. We usually run these specials anytime we have a webinar, just as a reward, a thank you for stopping by. But if you go down, you'll see that our regular monthly membership, $147 a month. We're going to do 13 months for an annual special. So you would take that 12 times 147, another bonus month of 147. That would be 13 times 147. So that would cost on a monthly membership $1,900 over 13 months. But we've got a special running through May 13th, which is this Thursday, for $997. So essentially, well, almost half price. So just want to make sure everyone is aware of that first. So if you have a, if your membership is going to be expiring soon, you want to extend, you can use this special. Also, if you're new to earnings beats and you're trying us out, you're in a trial period and you want to extend for that year, you can do so through Thursday at this reduced rate. Now, I also want to mention that if you are on a trial membership, you don't lose the rest of your trial. So let's say you're just a few days in, but you like what you see and you want to go ahead and extend for that year. You're going to get the full 13 months, plus you'll get the rest of your trial month. So essentially 14 months with your trial. So anyway, just wanted to make sure everyone is aware of that. Now, as far as the results go, and what we're going to do tonight, I'm going to go through and talk a little bit about the results in the last quarter. Go through some themes, some of the things that we consider when we pick our portfolio stocks, and not just the stocks, but also the areas in the market. I think the themes are very important there. And then talk a little bit about the earnings themselves, because we keep a strong earnings chart list, which is where most of our, nearly all of our portfolio stocks come from. So I want to talk a little bit about that earnings chart list, strong earnings chart list, to make sure everyone's aware of that. And then we'll, pretty much wrap things up. So hopefully I'm looking at this maybe going on for maybe an hour, hopefully not any more than an hour. I'll try to be done by 5:30 Eastern, but we've also got a couple spreadsheets that I want to go through and show you as well. But let's start off, let's get into the results. Now, before I get into the results, I want to show you something that was really important from a theme standpoint. And that was, this is the IWD ratio on February 19th. So this is as of February 19th. So this was almost 3 months ago. And the reason I want to show you this is when we do our portfolios, we do it as of a certain day. We do it based on the themes we're seeing at that time, and then we hold for 90 days. Now, we encourage our members to do whatever is most comfortable, but we have no idea what everyone's individual situation is. And so when we look at these various portfolios, we're trying to be transparent. We're trying to be consistent, and we focus on strong earnings and we focus on relative strength. But I'm going to annotate this chart for you because this is, in a nutshell, what happened to us this quarter. So when we were getting set back in February to select our stocks, one of the things I was talking about was this growth versus value ratio. And so we had moved up. We had a big pullback in June. A lot more value stocks were being bought heading into the early part of June of 2020. And then we broke back out again to the upside. You can see growth went up here and then went up again and topped in September. But notice when we pulled back, we came back down to about 1.69, but we didn't get any further than that 1.69 level before we turned back to the upside. So as we were going into this last quarter, growth was still in a sideways consolidation pattern, which had not broken down. I mean, we had gone down to this 1.69, 1.70 level on a few occasions, but it was difficult to say, were we going to break down? Were we going to break out? Sideways consolidation for a period of time. That's usually a basing pattern where we then break back out to the upside. So that was one of the big questions. And I know back in when I think we did the sneak preview and then also the draft itself, I was pretty confident that the stock market was going higher. The question that I was, kind of talking about out loud was, what was the rotation going to be like? And one of the keys was, does growth continue to lead? Because our portfolios absolutely knocked it out of the park in 2020. And the reason was we were heavily invested in growth stocks. And you can see the growth stocks were outperforming throughout the pandemic and throughout much of the year. So that enabled us to perform really well relative to the S&P 500. So this is where we stood on February 19th. Now, that was a Friday. And if you recall, I think we had a session on Sunday night, the 21st, to reveal our 10 stocks for each of our 4 portfolios. Well, if I back up here and we just go out one more day, I want to show you what happened on February 22nd, which was Monday. We broke down the very next day after putting these portfolios out. Now, again, our strategy is to hold. I mean, at this point, you don't know if the breakdown is going to result in a lot more selling. You don't know if it's going to be temporary and a big bounce back. That could have been a head fake. So even if we were doing it on February 22nd, I don't know that it would have changed a whole lot. I probably would have been a little bit more, a little bit less aggressive, a little bit more cautious. I know that's what we did with the income portfolio, but the other 3, we decided to stick mostly with growth because growth had not broken down. But literally the very next day, we got the breakdown. Now I'm going to show you the rest of the story so that you can see, since breaking down, we have not gone back up above that 1.70 level. So let's get an update through today. And so here was the breakdown right here, February 22nd. We went down. We did try to come back, couldn't get through 169. And now look at where we are right now at the low again. So this is just a snapshot and a picture of what's going on in the stock market in terms of growth versus value. There's a lot of really good looking charts in the market. Most of them are going to be value charts. There's a lot of really bad looking charts right now in the market. Most of them are going to be growth stocks. So when I talk about something like Trade Desk, TTD, you can see the big breakdown here. You can see that gap down and the selling. Look at the massive volume coming into the stock, and consider that Trade Desk beat on its top line, beat on its bottom line, and raised its revenue guidance. And with all of that, the stock went down 26% today, gap down quite a bit. All right, but if I stretch it out, actually, hold on one.
Hey, Tom,
Yeah.
I want to add one thing. They also announced a 10-for-1 split. Which,
yeah.
Which in the past used to be, the glory days. It was like, let's get the champagne out. Today it was like, no thanks.
Yeah, I mean, remember 1999, 2000? I mean, if somebody announced a 10-for-1 stock split, that was automatically about a 30% increase.
That day, yeah.
Yeah, that day. Yeah, we're not in that. In fact, I've been wondering if some companies are going to start issuing some of these stock splits. I mean, there's so many companies now that until it becomes kind of a normal thing where you can buy fractional shares, it's hard to buy some stocks. I mean, depending on how much money you want to you have to spend, I'm sure there are a lot of folks, smaller investors in the market, that look at Amazon, $3,200 a share, and they're like, I can't really afford it. So I think we might see more of this down the road, and I'm surprised more companies haven't come out and announced it. But obviously, that didn't seem to phase investors. They could care less about the split, and this is just all about selling growth stocks right now. Let's see here. So anyway, I just wanted to point out Trade Desk, because that one, to me, really, is the poster child for what we're looking at in the market. I've just seen so many tech stocks that have come out with really good numbers, and yet they're rolling over. And it might not be the reaction right at earnings, but it might be the next day. Just to give you another one, look at something like AMD. Where AMD came out with its earnings. Look at that gap up. I mean, they've reported great numbers. Stock gapped up to 88 and change. Now look at where we are. Less than 2 weeks later, we're back down 75 and change, threatening a key long-term support level again. More and more of these tech stocks are losing these support levels. So while normally that would be a great place to enter, and I still think it is, you've got to be careful, because if they do break down, we're seeing what happens when they break down. There's just a windfall of selling and not a whole lot of buyers out there. So we're seeing stocks getting hit pretty hard in a very, very short period of time. But anyway, when we look at the results, that, I just wanted to bring that up, because to me, that was kind of like one of the most important charts to show in terms of, what we were looking at in terms of portfolio results. Now, if you are a member at Earnings Beats, even a trial member, if you go into our website and go down to the stocks and portfolios, you'll see each of our 4 portfolios. And if you click on them, you can go get a sense of how these have performed over time. So we won't update the portfolios for the current quarter until we close out the quarter. But I can tell you many of these stocks are down. Some of them fairly significantly. It's been definitely a rough quarter for the model portfolio, but you can go back and look at every quarter and just see there's a performance summary at the top versus the S&P 500. So you can see which quarters we did well, which ones we didn't. But I can tell you overall, the model portfolio still is up over 200% since inception, while the S&P is up about 55% or 57%. So pretty good action. And like I said, you can click on whichever portfolio you want. And it gives you, just going back, you can pull up and see which stocks were included in the portfolios each quarter as well. All right. So let's move on to I don't have, I was going to show you a chart of each of these portfolios. We do a weekly portfolio report. And so if you're a member, every Sunday, you'll get a weekly portfolio report. Now, even though some of these stocks maybe are traded by members, some maybe are held throughout the quarter, what we do is just give a quick update. Actually, I shouldn't say it's that quick. It's a pretty thorough report going through and showing performance of all the stocks in each of the 4 portfolios for that week. Talking a little bit about the S&P 500, how our portfolios did relative to the S&P, and then usually one chart from each of the portfolios. So one out of 10 usually are updated in that portfolio report. So it's not something, portfolios, like I said, we hold them for 90 days. We want to try to be as transparent and as consistent as possible. So we hold, whether they're breaking down, whether they're breaking out, whatever they're doing, we hold them for 90 days. Sometimes it works to our benefit. This quarter, it has not worked to our benefit. It's obviously taken a big hit in our portfolios, but over time, this is what's worked for us. We've tried to be very consistent and very transparent. So that's what we're going to continue to do. Now, if we're sitting here another 3 months or 6 months, and we've had a couple more really rough periods, then maybe we'll consider changing that philosophy and that strategy. But for now, like I said, the long term, and that's really what we're focused on. We're focused on the long term. We obviously would love to outperform every quarter, but I think our performance last year raised the bar quite a bit, and kind of hard to meet that, those lofty goals of beating the S&P by 10, 15, 20 percentage points by, per quarter. That's over long periods of time unsustainable. Nobody's ever done it. I think part of it was because of the pandemic. We picked up on the accumulation distribution signal early. That helped us. And now I think the pandemic is reversing, and we're starting to see the reopening stocks performing very similar to the way many of these technology stocks performed a year ago. And now technology is going the other way. So it's just a little catch up, I think, that's taking place here. So as far as the results go, I would say based on what we're seeing right now, there's obviously going to be less growth stocks in the portfolios over the next quarter. I'm not interested in getting into growth stocks when they're free falling relative to the value stocks. So there'll be a mixture, but it won't be nearly as heavily influenced by the growth stocks going forward in the next quarter. Later in the year, there's a very good chance we go right back to it, especially in the fourth quarter when we do tend to see the aggressive stocks outperform. All right, let's move on to themes. So, the first thing I would just say, actually, let me back up 1 second before we go into the themes. Let's back up because I would like to show you one more thing. And this is an Excel spreadsheet. And what I've done here on this spreadsheet is, actually I got some help from Matt Townsend. So what we've done on this spreadsheet is just pull up each of the model portfolio stocks, each of the aggressive portfolio stocks. There's the income, and then there's the strong AD. And what I did is I went in and put in the revenues, actual revenues estimate, earnings per share actual, earnings per share estimate, the price back on February 19th, and then the price on Friday at the close. We were doing this during the day today. Just to give you a sense of what's been going on in these portfolios. And you can see many of the portfolio stocks got hit pretty hard. We've had a few winners, but usually what we see are stocks, like 5 or 6 doing really well, and then a few that aren't. And the ones that are doing really well really carry us to outperformance. Well, it got flipped on us this quarter. And many of those stocks that are underperforming are carrying us to significant underperformance this quarter. That's the strong AD. Now, one of the things I want to point out, though, is that these were all stocks that were, pretty strong heading into that February 20th to May 19th upcoming quarter. And if you look at the results, of the 10 companies, all 10 have reported during the quarter, although 3 are reporting again for the second time this quarter, this evening. I know Vuzi's reporting, Fluent is reporting, and Magnite, MGNI. Those 3 are all reporting, and all 3 got hit today heading into their earnings reports. I think the market is, or anybody holding in technology stocks right now, I think rather than buying into earnings, they're saying, hey, I'm getting out. So I think we're starting to see a lot more selling of these stocks as their earnings approach. But my point here is look at the revenue, how many beat revenues. 8 out of 10 beat revenues in the quarter this, within the last 90 days. Earnings per share, 9 out of 10 beat their earnings per share, but it hasn't mattered. And that's really important to understand because I think sometimes you think, okay, well, my stock beat earnings, we should be going up. I should be really outperforming. And when you look at the total earnings per share versus the estimate, it was almost a double if you add up everything in our portfolio. $2.94 versus $1.50. 8 companies beat revenues. 9 out of 10 beat earnings per share, and the stocks are getting hammered to the downside. Just tells you a little bit about what's going on in the market. Here's the aggressive group. So looking at this one now, Capri CPRI has not reported yet, so you can see there's nothing in here. So only 9 of these 10 companies have reported in the last quarter. 8 out of 9 beat revenues. All 9 beat earnings per share estimates. The total EPS 1254 versus 963. Easy beats. And yet most of the stocks getting hit to the downside. Then we go into the model portfolio. So Applied Materials will be reporting, I think, on May 20th, right after this quarter ends. And Sonos, SONO, reports, I believe, on this Wednesday. So they haven't reported yet. So 8 companies have reported. All 8 have beaten revenues estimates. 7 out of 8 beat earnings. And the ones that have missed, SEDG missed on I'll show you the ones that have missed here. Upwork missed by 2 cents. Here, the only miss was Shake Shack's revenues. And then on the strong AD, the only miss was SEDG, Solar Edge, which missed by 1 penny, 98 cents versus 99. That's how close it's been to an absolute perfect revenue and earnings per share beat among all of our portfolio stocks. And yet they've been beaten down. It has nothing to do with the earnings. It's all about the theme. And that's why eventually I believe these stocks are coming back. But you can't jump in front of the freight train. You know, even from a short-term trading perspective, you've got to be very quick on the trigger if you're going to try to trade any of these stocks into, you know, key support. All right, so let me show you the income. So the bank stock that we have is the only one that missed on revenues. All 10 beat on earnings. And look at the earnings total, 2476 versus 1871. Every single one of these beat, many of them by a pretty wide margin. And every stock except for Viacom, and actually Viacom was up 50% until it fell apart and dropped from $100 down to $40, maybe $38.50 as of Friday. So that was a big reversal. But the income portfolio has doubled the S&P 500 this quarter. It is actually a bright light among the other three portfolios, which have underperformed pretty significantly. All right, so let's move on now to themes. So let me get my charts back out here. All right, so let's pull up first the big picture. And this is what I continue to talk about. And this is why I don't get rattled when the market sells off. I believe we are in a long-term secular bull market that has a long way to go. And I base that on history. I think the stock market goes through cycles. I think we get into these, you know, these grand cycles where we have strong economic growth, we have strong earnings growth, we have money that rotates out of other asset classes and moves into equities. You just have all of these things coming together for a period of about 20 years. We saw it in the 50s and the 60s. We saw it in the 80s and the 90s. And then in 2013, when we broke above this double top, I think we've started a 20-year grand cycle to the upside. Now, we had a pandemic, we had a trade war, we've had, you know, all the congestion that we had back in 2015, 2016. All of this was very negative, but it's within the big picture uptrend. Think 1987 crash, very similar. Look at how the 1987 crash looked in this 20-year period. It was horrible then, but it was like a blip. Now take a look at the pandemic. It was horrible back in March and April of last year, but now it looks like a blip. That's what happens in secular bull markets. So I remain very bullish. So we talk themes. I'm very bullish. The stock market have been, you know, when a lot of folks were turning against the market a year ago, we stayed true to what we were seeing on the charts, which was a secular bull market. And I'm convinced that we will continue to stay in this secular bull market. Could we get spooked by inflation over the summer? Absolutely. You know, we've had this huge move. Are we going to have, you know, something else coming down the road from all this pent up demand? Is, you know, there going to be a storm at the end of this for several weeks or something? Very possible. Maybe this summer, you know, right in the midst of all this huge demand, maybe the market decides it needs to pull back. But whatever we see, in my opinion, is within the realms of this long-term secular bull market. And I think that's really important to keep in mind. Let's take a look at, what else do we want to look at here? Well, I think one of the keys is going to be the dollar, because right now we're seeing materials and energy performing really well. The only thing I would just caution everyone that I am seeing the 10-year Treasury yield here in the US versus Germany moving higher. Now, we did pull back for a period of time, probably the last month and a half. But the overall trend over the last 9 to 10 months has been higher. And generally speaking, when you see this moving higher, you also see the dollar move higher. there's a pretty strong positive correlation between all of this. So this is the difference between the US Treasury yield and German Treasury yield. And then this is the dollar index. And what we see, these different shaded areas, is when we see inverse correlation. So each one of these shaded areas leads to a period of inverse correlation. But after it's over, the dollar plays catch up. So here, the yield in the US was going up faster than Germany, but the dollar went down. We had an inverse correlation. The dollar came soaring back. Same thing in 2013, 2014. Yield going up in the US faster than Germany, dollar going down, dollar comes roaring back. Same thing here with this green shaded area. And right now we're in this green shaded area. Although we've actually gotten back to positive correlation, but I still see the overall picture here going higher. And I think as long as we hold about 88 or 89 on the US dollar index, that's what I'm watching pretty closely, because you can see these tops back here in 2009, 2010. We held it on this pullback. We held it on this pullback. Do we hold it on any further selling of the dollar? If we don't, and the dollar breaks down, that's when I think materials and energy have a much, much better chance of sustaining what they're seeing right now. And I'm going to show you the dollar. I want, again, this is a theme that's really important. But right now we've got energy, which since 2011, you can see the dollar bottomed in 2011, was trending higher. We've been moving down since we broke this channel or this trend line and moved lower right here. You can see energy's been outperforming, materials have been outperforming. But we haven't broken down on the dollar. We broke the trend line, but we still got higher highs and higher lows. I think we're still consolidating from the high in 2017 and the high in 2020. I think as long as we hold this low, I think I would still argue for the dollar going higher. And that what I showed you in the US yield versus Germany supports that right now. So if that's the case and the dollar strengthens later this year, I think you've got to be careful with energy and materials. Now, materials making a big run. I'm watching this relative high right here that was set at the beginning of 2018. Energy has not been nearly as bullish, but it's picking up. It's getting more bullish. And if you connect these trend line or this channel right here, the upper tops, I think we've got room to come back up a little bit further on energy. So I think energy and materials have more room, but I think the combination of the overhead resistance, relative resistance, we need to watch that. And then we also need to watch the dollar support level. Dollar breaks down, I think you're going to see more out of energy and materials. If the dollar holds and we start moving up, at some point, I think we're going to see this roll back over again. Because if the dollar goes up, that's going to keep a lid on commodity prices. Right now, everybody's talking about inflation, commodity prices are jumping. Part of it is just, there was a disruption to our supply chain, most areas of the market, because nobody was buying anything. Our economy was shut down for a while, and then we had restrictions. And so a lot of companies were not manufacturing because a lot of employees were being laid off and there wasn't the demand. And so you couple that with all of a sudden, all of this demand coming back, being fueled by stimulus, economic stimulus, being fueled by the Fed. I mean, it's being fueled by a lot of things, and just folks tired of being at home. They want to go on vacation. They want to buy a new house. They want to buy a car. They want to go to Starbucks. They want to get out and they want to do things. They want to get back in the malls. A lot of pent up demand. And so I think what we're going to see in the near term is all of this demand, which is over the top demand because of the pandemic, coming out of the pandemic, versus supply chain disruptions and lower supply levels in many areas, different classes within the market, different industry groups. And so high demand, low supply, and that's what's driving prices right now. I think it's kind of like a bubble working its way through the system. And we'll get to the other side of that. When we do, we're going to find out whether or not materials and energy lead. I don't think they do. But again, I didn't think they would 3 months ago, and here we are. So no guarantees. I'm just telling you, these are some of the signals, some of the things we need to be watching as we go forward. All right. Other themes that we look at. How about, we can, if you're familiar with the Dow theory, which I think most investors are, you got the Dow Jones right now, and we'll pull it up on a monthly chart, give you a long-term perspective. But there's the Dow Jones breaking to a new all-time high, hitting 35,000 today. The transportation index, all-time high. So there you go. Dow Transports and the Dow Jones Industrial Average, both simultaneously putting in highs. According to the Dow theory, that is a very bullish development. Historically, that has been very bullish for stocks. So it all fits with what we've talked about in terms of the secular bull market and this long-term bull market. And then you throw something in there like the XLY, XLP, which is a ratio that I like to follow. And we're sideways consolidating, but we've been uptrending. Let me see if I had that in there. In this other, here's a 10-year weekly chart. So you can see, back in summer of last year, we made a breakout above the 2018 top. So we've got higher highs, higher lows, higher highs. We could continue to come back down, maybe even test this 225 area. And we could go further than that. The key is just staying in this uptrend, but just a normal pullback would be to 225. So I wouldn't view, I'm not viewing this as negative long-term. Short-term, yeah. Consumer discretionary and technology stocks both under pressure right now. But I think the big picture, this still supports a bull market, in my opinion, a long-term secular bull market. Another thing that I always like to look at is copper versus gold. Look at copper versus gold right now. When that is going up, and I can let's annotate this so I can update this. But when this is going up, when that ratio is going up, look at how the S&P 500 does. Whenever this ratio is going up, the S&P 500 is normally doing very well. When the ratio is going down, you want to be careful. That's when the S&P usually is doing nothing or possibly going down. Here, basically went almost nowhere. Here it was very choppy. It went up, but it also had a couple of really big drops while it was going down. The reason that this is an important ratio is copper is something that's used in, for industrials. A lot of industrial companies use copper, and it's very important when our global economy is strengthening. You're going to see, for the most part, copper prices going higher. And copper, by the way, is at an all-time high. And that compares favorably with gold. And so we've been going up. Gold, on the other hand, does well when the market's fearful. The market's fearful when the stock market's going down. So gold tends to outperform much more in equity bear markets and during periods when equities are struggling and fear is rising. So really important to follow this ratio, which also points to a secular bull market advance. All right, let's see what else we have here. I'll tell you what, let's pull up that XLY, XLP, but I want to do a different chart. Let's look at the SML, SPX. So small caps had this huge run at the end of 2020 and the early part of 2021, but we've pulled back against the S&P 500 recently. And then you've got mid caps, which also I think have pulled back, but not as much. Mid caps are doing better than small caps. So there's your big rally, but it has pulled back a little bit on the mid caps versus versus the S&P 500. So that's something that I think we have to kind of watch as well. I believe we're still in an uptrend in the small caps and mid caps, but over the past 2 or 3 months, we have seen a little bit more weakness, especially in the small cap area. All right, so those are most of the themes that I look at when I try to decide, okay, where do we want to, what kinds of stocks do we want to own? And, where do we look for them? And that brings me to earnings and relative strength. So anybody who's been a member of Earnings Beats for a while or has been into these webinars with me before knows we follow relative strength. I mean, absolute strength is important. And you can see here, technology is still in an uptrend, higher high, higher low, higher high, higher low, higher high, higher low. Everything looks good, right? Wrong. On a relative basis, technology now has broken down to the lowest level since June of last year. Now, it may turn on a dime. It may turn today, tomorrow, or it might turn in a week. Maybe it's another 3 months. We had a lot of outperformance in 2020. Maybe we continue to go down for a while. I think you've got to be really careful with technology shares. Now, if you're looking at building positions for the next 10 years, I would be looking at some of the weakness on some of your favorite long-term technology names, and I would be adding to them. But as a short-term trader, you definitely do not have momentum on your side right now as far as technology goes. Then we've got consumer discretionary. Big drop back in February on a relative basis. We tried to get back in March, and now we're rolling over again. Consumer discretionary on an absolute basis looks fine. On a relative basis, though, money is rotating. Communication services, big move up first quarter of the year, pulled back. I think we're okay here. Certainly not where we were back in March, but also well off the lows that we saw back in January. Industrials, this is a leader. So if I'm looking at putting together portfolios, absolutely I want to be paying attention to the industrials. Industrials are leading. So if you want to beat the S&P 500, best way to do it is to do it with groups that are beating the S&P 500. Financials, beating the S&P 500, beautiful move to the upside. And it's not shocking to know why our income portfolio did well this quarter. There was only one technology stock, and I think only one consumer discretionary stock. We had a lot of other defensive areas. We had financials, we had industrials, we had areas of the market that, just the income portfolio itself, and trying to be a little bit more cautious, we didn't have a lot of the companies that had moved up significantly. Instead, we were looking for companies that were looking pretty good, but in some of the other areas where they hadn't made big moves and also paid nice dividends. And so that strategy paid off in this past quarter, whereas investing in growth did not. Healthcare. Healthcare is starting to strengthen. I've been watching this one. Just broke back up above the 20-day, which I think is important. We've seen it before. We saw this back in January. But if we stay above that 20-day, I think healthcare could just be starting to make a move. Now, if we go back down below, you see what we did back in July of last year, broke through the 20 and then failed. Here we broke through the 20 twice and we failed. Here we go trying it again. What we want to do is we want to strengthen to the point where we're able to hold that 20-week moving average and have that start to turn higher. So healthcare has been a laggard for a while, but I do think we're starting to see a little bit more strength there. Consumer staples, been beaten up, seeing a little bit of relative strength. Because technology is struggling and consumer discretionary is struggling, that's going to help consumer staples on a relative basis perform a little bit better. And I think that's what we're seeing there, along with real estate showing some strength here. Utilities off of the February low, starting to show a little bit of relative strength. I don't know that really it's that utilities have been that strong relative to the S&P. It's just that technology and consumer discretionary has been that weak on a relative basis. Then we've got our energy, which just broke out on an absolute basis. Did not break out on a relative basis, but I think it's poised to do so. And so, again, watch the dollar. There's some question marks there, but overall pretty good. I think far and away the leader right now is materials. And until we see the dollar really start to strengthen, I think materials continue to perform well. So short term, from a trading perspective, I think materials remain pretty strong area to trade. As far as our portfolios go and trying to, structure them properly, this is going to be a tough call. And we're not going to go overboard on material stocks, because if the dollar starts to strengthen, we could see what just happened with technology could happen with material stocks and or energy stocks. So while we want exposure, we want to be careful not to go too overboard with it. And we want to make sure we're sticking with a leader. So those are the sectors. So this is part of the evaluation process of going through and trying to develop, okay, how do I want to structure these portfolios? How much exposure do we want in these various sectors? And then it's like a top-down approach. I find, okay, industrials probably are going to be weighted pretty strongly over the next quarter. So within the industrials, I'm then going to go to my relative strength industry group chart list. Both these chart lists, by the way, are available to our annual members at Earnings Beat. So if you do decide to take us up on that special, you can get these lists, these chart lists downloaded into your stock charts account if you're an extra or a pro member. If you're not an extra or a pro member, if you're a basic member, you only get one chart list. So you're going to have your own by default. You're not going to be able to download any of ours. You would have to upgrade at Stock Charts to an extra membership. If you're not a member at Stock Charts and you want to try our service and also try Stock Chart service, both of us have essentially a no-cost trial. Stock Charts is free. Ours is $7 up front, but we refund it to you in a week. So essentially ours is free as well. You could try them both for 30 days. If you're not a member and you're not planning on becoming a member at Stock Charts, you can view our charts, but you won't be able to download the chart list because you need a Stock Charts account to be able to download. But you'd still be able to go through and review all of our various chart lists. You'll be able to review charts one at a time. So here, I'm just going to walk you through the industrials because that was a group that I thought looked really strong. So let's take a look at the industrials. And there are, I think, 16 industry groups. I'm going to walk through these pretty quickly. So waste and disposal was downtrending. Now it's starting to uptrend. It's not one of the best areas, but it did just break out. I mean, when you see the relative strength start to pick up here, it's because we finally took out that February high. So here's the absolute chart and the absolute breakout. And when the absolute breakout occurred, that's when we saw relative strength coming in. So that's bullish, but we'll probably get a pullback at some point because the group has run so much. Truckers just broke out on a relative basis. Very nice action. Solid movement. We talked about the transportation index earlier today. Of course, truckers part of that. Truckers are doing really well. It's certainly a group that we could consider. Business support services strengthening. Still got the, I look at the relative PPO a lot of times, and we're right up against that zero line. And I mean, if you look back here, see how we were moving up here for a period of time, and we actually even went just a little bit into positive territory, and then right back down again. So I'm not as excited about this one because it is right at the center line. I don't know if we continue to the upside or not. We did recently break out. I don't know. This is one that looks okay, but not going to be one of my favorites. Then we got diversified industrials. Looks like just breaking out again. That's really good action on this group. This is a possibility for a stock or two in our portfolios. And we've got industrial suppliers just breaking out above multi-year relative tops. That's really good news. And we've already broken out on an absolute basis. And now we're starting to see that relative strength. Defense stocks strengthening. And that's pretty good news. We had been in a pretty serious downtrend. Still got work to do. I don't know if we'll find a defense stock that we'll want to add to the portfolios. If we did, probably would be no more than one. Probably find the best one that's out there. And if it paid a big dividend, it might go into something like the income portfolio. If it didn't pay a dividend, then maybe it would find its way into one of the other portfolios. Next up, heavy construction. This has been one of the strongest areas, not just within industrials, but within the entire market. This has been one of the strongest areas since that July relative bottom. We have just continued to go higher. And you can see when we made this breakout right here in November of last year, that's where we broke out above the earlier absolute highs. And since that time, we haven't seen the relative strength line drop below that rising 20-week EMA, not once. So strong action there. Transportation services. Right now, we are at a 2.5-year high. Pretty solid action. We've broken out above that high that we saw back in September 2018. This is a group that looks like it certainly could continue moving to the upside. Industrial machinery, getting close to resistance area, but you can see it has had its weekly PPO, relative PPO above the center line now for quite a while, and it is turning back to the upside again. So this group looking pretty good. Railroads have been kind of weak, and you can see all this overhead congestion on a relative basis. Now, we did break out again recently, and again, this is part of the transportation index. The group looks good. I think eventually we're going to get this breakout. So it's a solid group. Marine transportation, probably one of my least favorite groups. We did break above the 20 recently, but we couldn't get back up above that June relative high. We're still above the 20, which is above the 50. The relative PPO is above 0. I would just have very little tolerance if this group were to roll back over again. Building materials and fixtures, very strong action. This one broke out back in August of last year, and for the most part, you can see it's had very strong relative strength since then. Aerospace, kind of like defense, still not there yet. This is a group that I think, will have opportunities going forward, but it's got to clear these relative highs. And that probably isn't going to happen until we get a breakout above the 2019 price highs. And then the last one here, this is commercial vehicles and trucks. Very, very solid action on a relative basis and on a absolute basis. This again is one of the stronger areas. So then, from there, we're going to take a look at the earnings. So I'm going to pull up something. Oh, I don't have the latest. I didn't download. I've got this. I've got it in my other account, but not in this one. Anyhow, let me just explain, what we're doing here. And I think if I go down here, yeah, some of these stocks are included. So I know ODFL, for instance, is a stock that's in our strong earnings chart list. So for those of you that are new, what we do, and this is really one of the, this is almost like the foundation of our service at Earnings Beats. My background, I was in public accounting for 20 years, and I've always found it much more beneficial to trade companies that have beaten Wall Street estimates as to both revenues and earnings per share, because they haven't dropped a bomb on Wall Street. Wall Street is much more likely to believe their future guidance and growth rates if they're reporting numbers that at least beat what they had promised in the past. So most companies, and many successful companies, Apple comes to mind right away. These are companies that under promise and over deliver. Apple has a history of beating its earnings estimates, because when they tell Wall Street that, okay, this is what we expect going forward, and next year we expect this, and next year we expect this, they're always beating their current estimates. And so Wall Street always feels that they're going to beat their future estimates, which is why they're willing to give higher multiples to a stock like Apple. I just feel like companies that beat in their latest quarter, I have more confidence trading them. So any company that comes through and beats revenue in their latest quarterly report, if they beat their revenue estimate, they beat their earnings per share estimate, and I look at the stock and I see that it's part of a good group and that it's outperforming the group, it's one of the leaders, and the group is outperforming the S&P 500. I mean, this would be the typical stock. Maybe if I picked a trucker, Old Dominion could be one that I would certainly consider, because not only is the group going higher, but here's a stock that's outperforming its peers. It just set a 52-week high relative to the trucking index. So leading stocks and leading industry groups, that's how we've outperformed over the long term with our portfolios. And that's what we'll continue doing as we go forward. So Old Dominion Freight Line, I think looks good. Don't like that candle today, to be honest. Volume picked up. That's a gravestone doji where you have a long tail to the top. You open and close right near the low of the day. I wouldn't be surprised to see a short-term top, maybe a move back to test that 20-day moving average on Old Dominion, just based on that candle. But overall, I like the stock. So what we end up doing is we have all of these companies when they report. I just went through 1,200 companies over the weekend. looking through their earnings reports, finding the companies that beat both top and bottom lines, and then looking at the charts. And we just updated the strong earnings chart list today, if you didn't see it in the daily market report, if you remember. So we were just letting you know you can go in, you can download that latest list. Right now we have 624 companies on our strong earnings chart list. 624 companies, the most we've ever had. Why? Because companies are blowing away estimates. Even companies that are now performing well, like Trade Desk, is blowing away estimates. But in order to get on our list, we need to see technically strength as well. So something like Trade Desk that beats, but then gaps lower and sells off on massive volume, they will not be on the strong earnings chart list in this quarter. Now, what happens is we're constantly rotating. It's like a turnstile. So companies, ODFL, when they report their earnings, they go on the list. As they get close to their next earnings report, we take them off. And then they'll report. And if they report strong numbers again, beating estimates, and the chart looks good, they'll go back on the list again. So every company will come off before earnings and then go right back on if they beat and they look good technically. That's how this strong earnings chart list, and we've been updating it. I've been trying to update it once a week. It's a lot of work, especially during tax well, it is technically still tax season, I guess, but I mean earnings season. As long as, we've got hundreds of companies coming out, it's really difficult to update this once a week. But like I said, it's kind of the foundation of what we do at Earnings Beats. So it's something that we really want to focus on and make sure we do. So here is that earnings chart list. Now, what we would do, and again, this particular chart list has not been updated. This is dated a bit. Tell you what, maybe let me show you how easy this is to do this. So we've got strong earnings number 1, strong earnings number 2. So I'm going to go in here and show you, for those of you that are new, this will maybe be a little quick lesson. But if I go down here to strong earnings chart list, here are the 2 chart lists. You can only have 500 stocks on a chart list. So when you go over 500, you're going to have 2 different chart lists. So that's why I'm going to have strong earnings number 1 and strong earnings number 2. All you have to do, we do all the work for you. If you come in here and you highlight and copy that password and click on this link, then I'm going to paste my password. I'm going to unlock the list. There it is. I'm going to save the chart list. I'm going to replace a chart list that I already have, which is strong earnings number 1. This way I'll have the most recent information. And so that when I pull them up, we're going to wrap this up here in just a couple of minutes. This is going to be the last thing we do. I just want to show you how you can pull up a chart list and sort it to begin to look for some of the stocks. All right, so that's a big chart list, 400 and some. That's how long it took to download it right into my Stock Charts account. So if you're a member at Earnings Beats and a member at Stock Charts, you now can just go right in and download like that. It's pretty cool. All right, so let's back up here and let's go to the second one. And now I'm again going to grab that password, copy, hit the link, paste the password, and now SECL number 2. And I'm going to save that, replace a list because I've already got the list. So I'm just going to update it. And I'm going to save results, strong earnings number 2. Now, one of the things that I did, I was talking about transportation services and how I thought transportation services looked, really good. So let me show you how I would consider looking up something here using our research platform. So when I go in now to, and let me go back here, update this so that I make sure that I've got the chart lists updated. Okay, so there's chart list number 1 and chart list number 2. So what I can do is I can go back to the dashboard and I can run a quick scan. So let's say I'm thinking, okay, transportation services is an area that I'm really interested in. Maybe to put one or two stocks in our 4 portfolios. So I'm going to go in, I'm going to do a new scan. And I don't need a filter because I've already filtered. When we have a strong earnings chart list, it's already been filtered. They're all liquid stocks. They wouldn't be in there if they weren't liquid. So I don't need a volume filter. I don't need a filter telling me it's a stock because it wouldn't be in the chart list if it wasn't a stock. So what I can do is go down here to chart lists and I can grab the strong earnings #1 chart list and then grab strong earnings #2 chart list, add both of those. So now you'll see them up here. And then come over here to sectors, go down to industrials. And I could just do all industrials, but right now I just want to look at transportation services. So I'm going to add that. So now what I want to do, if I leave it like this and I run the scan, it's going to come back with 0. And the reason being, every stock on my strong earnings chart list #1 is different than every stock on the strong earnings #2. There's 624 different companies. So if I write a scan where a company has to be on all 3 of these in these 3 areas, it's going to come back as 0 because I don't have any stocks that are on the strong earnings #1 and strong earnings #2 chart list. So what you have to do is that has to be an OR. And any 2 things that are separated by an OR, you got to make sure you've got brackets, double brackets around it. So now what it's doing is it's looking at 2 things. It's looking at, okay, is the stock on either of these 2 chart lists? And is it also in transportation services? By running this scan, it'll tell me if any of those 624 companies are in transportation services. And so I'll run scan. 4 of them. And if I sort it by scooter, these are the 4 that I know the earnings have beat. So these are the only 4 that can go into the model portfolio, the aggressive portfolio, and the income portfolio because you have to be on the strong earnings chart list to be included in any of those 3 portfolios. The only exception is our strong AD portfolio, which stands for strong accumulation distribution. And that can be based on the AD line, the technical indicator, the accumulation distribution line. But they still, in practice, tend to come from this strong earnings chart list. But anyway, from there, now I've got the 4 and I can put them into I can store them into or replace an existing chart list. So let me put them in some kind of scan results folder. Scan results other. All right, so now I can look at them 10 per page. So I can quickly take a look at these 4 stocks. So here's AER. Beautiful move up, sideways consolidating. Looks pretty good. Not overbought. The PPO now is back down to 0. So that's good. I think that one looks pretty good. MIC has been trending higher, so it's going to be a little bit more overbought. Same goes for Ryder. Don't like that candle today on Ryder. But anything back down close to the 20-day moving average would be interesting. And then XPO Logistics, one of the better stocks in the group, big breakout there. 20-day moving average. You can see a couple of 20-day tests. That's been great entry. So that's how I can go from my relative strength charts to find the areas of the market that are working in terms of the sectors, break down the sector by industry group, see what's working there, and then go back and look at the research that we've done to find the stocks that meet our criteria. And so I think that's really important and hopefully helps to explain how we're going to go about selecting these. All right, that is about what I had for today. So I don't know if we have any questions, John, if you can hear me.
I can hear you.
Okay.
I don't see any. This is a group that's just sort of, I think, interested in hearing what you had to say. I think you laid it out as clear as possible. And we're going to be having the official event on the 19th of May, which is, I think, a week from Wednesday.
Yeah, it's coming up in just 9 days. I think that's going to be a really great session. I'm looking forward to it. I mean, obviously, with all the growth stocks we've had and the poor performance in 3 of our 4 portfolios, I'm really looking forward to shaking things up a little bit and getting back to some of the leading stocks going forward. So looking forward to it. I do want to just mention again, I pulled up the page. If you are new, you can go to earningsbeats.com, click on that webinar special, and or even if you're a member, if you're coming up for renewal, any of these webinars is usually a pretty good time to renew, because we are offering that additional bonus month. So you get 13 months for the price of 12, and the annual will save you quite a bit of money going forward. So, all right, well, if we got no questions, I would say let's go ahead and wrap this thing up. Again, we're looking forward to next Wednesday. And of course, next Tuesday, I believe, is Max Payne. So we got some more events coming up here over the next week to 10 days. And got lots to go over in terms of the market. And one last thing before we go, I am in the process of updating a lot of our chart lists. When we're in the midst of earnings season like this, it's hard for me to get a whole lot more done than just the earnings themselves. I mean, literally, I was looking at charts all weekend. I think 1,200 in total from last week to update. And then once we pick the stocks, we got to get all the data together, all of the earnings and revenue data that we put on our website, and then also annotate the charts. So our strong earnings chart lists are annotated. So it takes a long time to go through all of that. But now that that has been updated through Friday's close, should be able to update the short squeeze chart list. I know seasonality report that normally comes out beginning of May. I'm going to try and have that out to you tomorrow. And
Hey, Tom,
guidance. Yeah,
got a few quick questions that came. You want to handle them?
sure.
Okay, the market's moving faster and faster. Maybe portfolios should be picked monthly with a question mark.
Well, it's kind of almost everything we do in terms of our research platform and everything we set up is really based for a short-term trader. And what we did with these portfolios is they were designed to be educational, in that we're trying to teach folks how relative strength works and how our strong earnings chart list works over periods of time. The problem I have with monthly is I'm afraid we're going to get whipsawed, number one. And number two, those who, have written into us in the past that really enjoy doing these portfolios, they like the fact that they're not, going through and adjusting their portfolios too often. Now, obviously, it would have been great this past quarter if we had been doing it every month. We could have gotten out of those growth stocks a lot quicker. But I would just emphasize that it's really, we leave everything up to our members. We hold for 90 days. We've had some questions from members about using stops and so forth. And in the weekly portfolio report, every single week, I put in there, we don't use stops, but we encourage our members to do what's comfortable for them. And the reason I say this and we take this position is that we have a lot of members with a lot of different strategies. And I can guarantee you the first time, well, we did use stops a couple of times, and we had members write to us and say, oh, I was at work, I didn't get the message. Now what do I do? And so we were it doesn't matter whether we have stops, we don't have stops. It's going to be appealing to some and not so appealing to others. And like I said, we don't have a clue how, what everyone's personal risk tolerance looks like, what their strategies are in the market. And so we try to just lay out, this is what we're doing, customize it to however it fits you best. And I think that's the best way we can go about this. I think looking at last quarter and saying what was a bad quarter, we should start doing every month. Well, I think, if we had done that, things may have been different the previous 3 quarters where we crushed the S&P 500. So I look at it from a long-term perspective, and yes, it was a bad quarter, but long-term, I think all of our portfolios, all of our stock portfolios right now are ahead of the S&P 500 since inception. And that still speaks volumes to me. So I think we'll continue to do things.
Okay.
We're doing.
Do you try to find stocks which are in the strong earnings plus in the AD?
Well, that's another chart list I'm going to update here soon. I've been holding off on the strong AD and only updating it every couple of months because I don't think, number one, you have a strong AD one week and a weak AD the next. That's just not the way the AD works. So I've been updating. I try to make sure I update it right before the portfolios come out because we have a portfolio that will be based on the strong AD list. So I'll be updating that. I mean, I would consider using the chart list together as you see fit. I mean, I use a lot of times the strong earnings and the strong future earnings together. You know, and our various scans that we have, the scanning strategies on our website, some go with certain chart lists better than others. For instance, I mean, a 52-week high scan against the short squeeze chart list, I think it would be awesome to run every day. Because if you're setting a new 52-week high and you're on the short squeeze chart list, it means you got a ton of shorts out there. And if you got a 52-week high, you might be running into a short squeeze. You could even change that from a 52-week high to a 20-day high or a 30-day high or a 50-day high. Anything that's starting to show strength, running it against a short squeeze chart list would make sense. Now, I wouldn't run a pullback scan like an RSI 40 to 50 scan. To me, running that against a short squeeze chart list is not good because I want to see breakouts. I don't want to trade pullbacks on the short squeeze chart list. So it just depends on your style and your strategy, and just go in and tinker with it a little bit and see which ones, which of the portfolios and which of the chart lists and which of the scans you like, and go from there.
All right. Probably need to wrap up here. Will you be holding on to any of the stocks from the past quarter?
Oh yeah, there's always some. I'm sure some of those income portfolio stocks, I mean, they've been on fire. They've probably more than doubled the S&P 500 as of today's close. I think they were having another decent day versus the S&P 500. So yeah, there'll be some, and there may be some from the other three portfolios that have done well. I mean, Crocs is one that comes to mind. That's a stock that's continued to perform very, very well, even though footwear itself, that industry group hasn't done well. But yes, there will be some carryovers, probably not nearly as many as we've had in the past 3 or 4 quarters, because in the last 3 or 4 quarters, many of those growth stocks, we just kept a number of them in. We just kept riding them. That is not going to be the case, as many of those growth stocks have really fallen apart this quarter. Any more? Or is that it?
Any chance we're losing monthly seasonality a day or two before the month begins?
I mean, seasonality, I'd be careful about using seasonality as a reason to buy or sell. I always use seasonality as it's kind of like, liking a stock and then seeing it test a key support level. And so you feel like, hey, that's giving me a little more confidence to go into the stock because it's already pulled back and it's hitting a support level. Or maybe it's breaking out, but it's breaking out with a really strong PPO as opposed to, say, a negative divergence. When I look at seasonality, I look at seasonality as an addition to what I'm seeing on the chart. So if I like a stock, it's breaking out, then, oh, by the way, May is a great seasonal month for the stock, I'm going to feel more confident about that stock rather than the other way around. I wouldn't look at a stock and say, oh, it's got a great May, it does really well in May, let me buy it, and then go back and look and see what the chart looks like. I would never do that. I would want to see that the seasonality is strong, and then also find a stock that sets up well technically.
Okay, this one comes up. This will be the final one. Do you personally own all the stocks you recommend in the portfolios? If some of them, do you mind telling us?
I own some of them from time to time. I actually tried to follow the portfolio. Of course, it was one of the portfolios where we weren't doing very well. Not this quarter, but I don't know, maybe 4 or 5 quarters ago. And because the portfolios were doing really well, and I thought, okay, I'm going to go ahead and jump in and just hold on for the quarter. What I found for me personally is that that's not my style. My style is to trade. And so what I was finding is that I would hold as long as they were doing okay, but as soon as they started to lose any support levels, I wanted to get out of them. So the portfolios holding them for the 90 days doesn't work for me. But I do trade, and I would say the majority of my trades are portfolio stocks, because those are 40 of my favorite stocks on the chart list. That's why they were in the portfolios to begin with. So I just kind of use them as trading vehicles from time to time. Now I know my daughter Erin has bought portfolios, the entire portfolio, and she'll hold them for the entire quarter. But I think it just comes down to each individual. I mean, I think if you're really a trader at heart, it's going to be hard for you to hold these things for 90 days. And if you're somebody who likes to buy and hold, you're probably not interested in buying and selling throughout the week. So we've got a lot of different members, a lot of different strategies, a lot of different styles. And I think it just comes down to each individual style. But to answer your question, no, I have never bought all 40 of the stocks. First of all, I don't have that. I don't have a massive portfolio, and some of the stocks, I mean, to get 40 of them would be very, very diversified. And that isn't really something that appeals to me. I don't want to own 40 stocks. I rarely own more than 5 to 10 stocks at a time, because as a trader, it's hard to keep. And I'll be honest too, with earnings beats and all the work I do with earnings beats, it's really hard for me to stay on top of my trades. I just don't have the time, and my trading results have been worse simply because I don't have full time to devote to trading. So I don't know if that helps or hurts, but no, I would not be holding personally, I would not hold all of the portfolio stocks.
All right, I think that's it. I think it's time to wrap up. I want to make sure everybody understands they'll get a copy of the recording. Remember, next week's event, this is a free event open to all members of the Earnings Beats community. Next week, members only. You can be a trial member. If you're not a trial member, you can join for no cost. Cost you $7, and then we refund the $7, and then you've got 30 days. That'll get you a ticket. Of course, all of our other members automatically get in, but I will tell you that these quarterly events, without question, are the most popular events of the year. So I imagine this will be, the same thing. So if you want to get involved, you're not a member, just sign up for the trial. That'll be it, Tom.
Great. Sounds good. Then you do have the special through Thursday, the 13th, for the $9.97. Just make sure you go into earningsbeats.com, check out that webinar special, and it'll be up through Thursday. So with that, appreciate everybody stopping by, and have a great evening. And hopefully join me tomorrow over at Stock Charts TV for the next Trading Places Live. And you can also join me on my blogs over there as well. Everybody have a great evening. Take care.